Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of the new OVDP penalty framework. Technically, OVDP was closed September 2018. There's also something called Traditional Voluntary Disclosure Program. It's been on the books forever. But while OVDP and previous OVDI was around, that's the program you'd use for offshore-related matters. Fast forward to 2019, OVDP had been closed, but the IRS expanded the traditional voluntary disclosure program to include much more information and framework about how to handle offshore-related cases. So the voluntary disclosure program now, the traditional voluntary disclosure program, is used for both domestic and offshore. Today's presentation will focus on offshore. Not everyone qualifies for the Streamline program. There are some practitioners out there, lesser experienced guys and gals, who will automatically throw someone into Streamlined, even if they were willful, just because they have a little bit of unreported income. If they're willful, they don't qualify for the Streamline program. So plenty of people still have to use the traditional voluntary disclosure program if they want to get into compliance. The old program had a more concrete framework, so to speak. It was generally a 27.5% penalty unless any of the money was from a bad bank, foreign financial facilitator, and then the penalty would jump up to 50%. Under the old penalty framework, the compliance period was 8 years. For each one of those years, there was additional 20% penalty on the tax liability due from the unreported income. So basically what you would do is you'd look at the unreported income for each year in the 8-year compliance period, and for each one of those tax liabilities, if there was one, right, you would have a 20% penalty on top of that. The 27.5% penalty was not negotiable. You would have to opt out. Opting out meant staying within the program, but opting out of the penalty to try to get a better deal than you were getting at the 27.5%. We had handled several opt-outs. We were successful, but it is a very big undertaking. It's very stressful for the client because hyper-technically there could be a higher penalty in the opt-out than there would have been had they just stayed in the program. So the new framework is different. Under the new framework, the memoranda basically tells the agents, examiners, whatnot to go by the Internal Revenue Manual and the code, which basically says for the FBAR penalty, it's going to be 50% of the highest year's unreported maximum balance, or 100,000, whatever's higher. So that basically says 100,000 is the floor. There is some discrepancy in prior regulation that says 100,000 is the max per year, or some attorneys have claimed 100,000 max total. Most courts, almost all courts, and to date, no appellate courts have agreed with that position. So the IRS is still taking the position that the penalty is 50% or 100,000, whatever is higher. The compliance period is only 6 years now instead of 8 years, and the 20% penalty is no longer around. Rather, it's a 75% penalty only on the single highest year. So it used to be 20% per year for 8 years, new program, 75% 1 year. Now, what's interesting about the new program is because the agents and the examiners have to go by the manual, there is the potential to get those penalties waived. In fact, in accordance with the memoranda, it basically says, look, we're not going to automatically penalize individuals for information returns that might not have been filed. That could include 3520A as an Apple for foreign trusts, 5471 foreign corporations, 8865 foreign partnerships, etc., etc. Now, most of the time, or at least a good portion of the time, when a client submits to the voluntary disclosure program, they have to go in with the idea that they're probably going to get hit with that 50% penalty. But the agents do have some wiggle room to try to negotiate that penalty. Presumably, even if they were going to agree, they would need the approval of their manager or supervisor. So it's definitely a multi-step process. But at the end of the day, there are plenty of clients who would actually fare better under the new voluntary disclosure versus the old one. Some practitioners out there make it sound like the new voluntary disclosure is a bad deal for everyone because of the 50% FBAR penalty. But first of all, that penalty might be negotiable. Second, if a client only has a minimal amount of unreported income, let's say they were willful, their FBAR penalty is not too bad, and the primary concern is the informational returns, they may fare better under the new program than they would have fared under the old program. If the client disagrees with the results, it doesn't appear as though currently, because it's still in the earlier phases, that there is a specific opt-out per se. Rather, by submitting to the program, the client's going to be subject to audit anyway. As we've gone through the program, we find that most of the time the agents are submitting a technical audit. So there may be information document requests that would have been provided anyway under the traditional OVDP. It doesn't, at least so far, seem much more intense than it would have been under traditional OVDP. In fact, with the compliance period being 25% shorter, that also tends to benefit clients who may have had bigger issues in the past and in the future. That's an introduction to the different OVDP penalties, the new one versus the old one. We have lots of free resources available on our main website, goldinglawyers.com. Again, my name is Sean Golding with Golding & Golding. Thank you for your time.